One of the biggest problems I see right now in Phoenix real estate investing is out-of-state investors buying properties based on spreadsheets instead of how the market actually behaves. And honestly, I understand why it happens. Phoenix looks attractive from the outside. Population growth, tourism, warm weather, strong travel demand, business growth, seasonal visitors. And then investors start looking online and they see revenue projections, AirDNA screenshots, YouTube videos, and TikToks talking about cash flow Airbnb properties. So they assume if I buy a decent property in Phoenix, this thing should print money. But what a lot of people don't realize is that Phoenix is not one market. It's a collection of very different submarkets, and those differences matter a lot more than most investors think. Because I've seen investors buy properties that looked amazing on paper, and 6 months later, they're frustrated, stressed, and wondering why the numbers never matched expectation. So in this video, I want to break down the biggest mistakes out-of-state investors make when buying in Phoenix, and more importantly, how to think about this market strategically before making a purchase. Because honestly, I think a lot of expensive mistakes can be avoided if investors understand what actually drives performance here. The first thing investors get wrong is assuming all Phoenix area locations behave the same way. They don't. Scottsdale behaves different than Chandler. Tempe behaves different than Glendale. Arcadia behaves differently than Mesa. And if you don't understand the demand drivers in each area, it's very easy to buy the wrong type of property for a wrong strategy. For example, a property near Scottsdale nightlife may work very well as a vacation-focused short-term rental, but that same strategy may struggle in another area where demand patterns are completely different. Meanwhile, some locations perform incredibly well as midterm rentals because they're near hospital, corporate corridors, seasonal employment, or relocation demand. That's why I always tell investors, you cannot separate location from strategy. They have to work together. And honestly, this is where a lot of online investing content becomes dangerous because people oversimplify markets. They say things like Phoenix is a great Airbnb market, but that statement by itself doesn't actually mean anything. Which neighborhood, which type of property, what price point, what strategy, what operational plan, what seasonality assumptions. Those details matter massively. Another major mistake I see is investors relying too heavily on projected revenue tools without understanding operational realities. Now, don't get me wrong, data tools can absolutely be helpful, but they're not the full picture, and sometimes investors treat projected revenue numbers like guaranteed income. That's a problem because revenue projections don't tell you how competitive the property is, how strong the furnishings need to be, how much management affects performance, what guest expectations are, what seasonality feels like, how much operational intensity is involved. And they definitely don't tell you whether the property is actually a good fit for your goals as an investor. I've seen properties with huge projected revenue numbers become stressful nightmares because the operational side was completely underestimated, especially with short-term rentals. People hear the phrase passive income and think the property is basically running itself. It doesn't. A furnished rental business is an operational business. That means cleaning coordination, maintenance, pricing management, guest communication, vendor relationships, turnover logistics, marketing, revenue management. And if those systems are weak, performance usually suffers. This is honestly one of the reasons I think investors should discuss management strategy before they buy, not after, because operations impact what type of property even makes sense in the first place. Another thing out-of-state investors underestimate is HOA restrictions and local regulations. This is huge. I can't tell you how many times investors get emotionally attached to a property online before understanding the rules attached to it. Some HOAs restrict rental duration. Some communities create operational limitations. Some neighborhoods simply aren't a good fit for the strategy the investor wants to run. And unfortunately, by the time some investors discover that, they're already under contract. That's an expensive lesson. This is why local market knowledge matters so much. Not because someone has access to secret information, but because understanding how these neighborhoods actually function operationally can save investors a lot of money and frustration. Another mistake I see constantly is people analyzing deals based only on peak season performance. That happens all the time in Arizona. An investor sees incredible numbers during spring training, winter tourism, major events, or peak travel season, and they assume that performance stays consistent year-round. It doesn't. Phoenix is seasonal. You have to understand slower periods. You have to understand occupancy shifts, and you have to underwrite deals conservatively. Honestly, Conservative underwriting is one of the most underrated skills in investing right now because overly optimistic assumptions are what get investors into trouble. And unfortunately, social media often rewards optimism more than realism. But realism is what protects your investment long term. Now, another thing I think out of state investors struggle with is choosing strategy based on hype instead of alignment. Everybody online wants the best strategy, the highest cash flow, the best returns. But the truth is, this best strategy depends on the investor. Some people are great fits for short term rentals. They understand hospitality, they're comfortable with operational complexity, they want higher upside potential, and they enjoy optimization. Other investors are much better suited for midterm rentals. They want stability, lower turnover, less communication, more predictable occupancy. Neither is wrong. But problems usually happen when investors force themselves into a strategy that doesn't fit their goals or personality. And honestly, I think this is why so many people burn out. They buy based on excitement instead of alignment. That's dangerous. Personally, I think the investors doing best right now are the ones approaching Phoenix strategically instead of emotionally. They're analyzing neighborhoods carefully. They're matching strategy to demand. They're thinking about operations early. They're underwriting conservatively. And they're focused on long-term sustainability instead of chasing unrealistic projections. That's what I'm seeing work consistently, not hype, not shortcuts, not buying whatever property happens to look good on a spreadsheet. Because at the end of the day, a successful investment property is about more than just buying real estate. It's about buying the right property for the right strategy and actually executing properly afterwards. That's the difference. So if you're an out-of-state investor looking at Phoenix, Scottsdale, Chandler, Tempe, or anywhere in Arizona, and if you want help figuring out which areas, strategies, or property types actually make sense for your goals, I've put together a short intake form below. It takes about 2 minutes. That way I can understand your budget, your timeline, the type of investment you're looking for, and what you're actually trying to build before we schedule anything. Then, if it looks like we're a good fit, I personally reach out and we can map out a strategy together. Because in this market, especially, buying the right property matters. But matching the right strategy and execution of that property matters even more.